Welcome to my Accounting 1110 review for the final. In this review, we're going to examine the important topics from Chapter 6. You know, I suggest you watch the pencast and do the homework so you know the drill. We'll just hop right in. Getting better at making these final reviews. I'm going to start with summarizing what we're going to do with Chapter 6. First thing we're going to do is continue our discussions on inventory. And this pencast is going to focus on the perpetual method, because it is the perpetual method that's going to be covered on the final exam. Although some of your instructors may have covered the periodic method, that would be optional. It's not part of the required curriculum. What we're going to learn to do as it relates to the topic of inventory is examine how you calculate cost of goods sold. In the past, we've been given that. So that's one of our objectives. What do I mean by that? When you record a sale, in the past we've said record a sale of merchandise inventory for $10,000, making this up as I go. And then we'd give you the cost and say, the cost of that sale is $8,000. And you would simply record cost of goods sold and take it out of inventory. Well, one of the things we're going to do, and probably spend the most time on, is come up with how you get that cost of goods sold number. And in that examination, we're going to look at 4 different methods of doing that. And the methods are specific ID, which I'm not going to spend much time on, because once we've done the other 3, you'll know how to do that one. And then FIFO, first in, first out. LIFO, last in, first out. And then the weighted average. That'll use up a whole pencast. Then, I'm going to examine an idea of valuing inventory at the lower cost or market. Call that lower of cost or market in abbreviation. Must show inventory at a conservative amount on the financial statements. And on that same pencast, we'll take a look at what errors do on financial statements as they regard inventory. And look at a couple of ratios that you can do by way of financial analysis on the topic of inventory. Inventory is one of your biggest current assets, and so it's one of the most watched numbers. On this pencast, I'm just explaining to you what we're going to do in upcoming ones, and I want to talk about a couple of generally accepted accounting principles next that surface logically on a discussion of inventory. So let's finish up this pencast by looking at some new topic or some new vocabulary. You'll be ready for some questions on the final relating to generally accepted accounting principles, which I wrote as a gap that we haven't covered yet. Alright then. Forgiving me for speaking quite softly, but it's 4 o'clock in the morning and people are asleep at my house. I'm trying to get this done, get ready for finals, and it's a new book. So, sorry about the turn it up. So, vocabulary I want to look at are the terminology and the accounting principles really are consistency, disclosure, materiality, and conservatism. Consistency. What do you think that might mean? What it means is that you use the same accounting principle from period to period. So you're not picking the principle that leads to the most favorable income one period when you want a lot of income and fewer taxes in the next. Generally accepted accounting principles say you must be consistent. You must use the same principle from period to period. And they do that because they want investors to have comparability from period to period. That helps when you're looking at ratio analysis. Makes it so you can look at trends and spot how things are going in the business. So, it doesn't mean you can't change a principle from period to period. It means you're not supposed to just to manipulate income. If you have a good reason, you can. What that boils down to in inventory is if you pick a method, you continue to use it from period to period. And if you don't continue to use it, that you have a very good reason for changing. Let's talk about disclosure. The disclosure principle is about sharing information. You want to report enough information to your shareholders so that they can make good decisions. The kind of information you share should be faithful and it should be relevant. Relevant to the decision of do I want to invest this, and representationally faithful. Isn't that an interesting word to use? That you're not manipulating the numbers to look in any particular direction. So you share with them information. A lot of it's in the notes where you tell them which method you used. FIFO, LIFO, weighted average. Or perhaps specific ID. And you also tell them if you've valued your inventory at the low of cost or market, one of the things we'll talk about, what that adjustment was. So some of the information is given in the financial statements themselves, and some of the information is given in the notes to the financial statement. Let's talk about materiality next. Materiality is an interesting principle. It says we don't get carried away with our accounting. After everything you've done, you're saying don't get carried away? Have you seen what we've been doing? What that basically means is that you apply generally accepted accounting principles in a consistent manner and on a regular basis. But that if something is really small and insignificant, you don't have to worry about it so much. An example might be you had a lower of cost or market adjustment from a test, but it was less than 0.25%. It was occurring less than 0.25% of the time. And it wouldn't be worth the effort of going through and calculating that adjustment because it's just not big enough to make a difference. So you don't have to. It doesn't mean you don't have to record your transactions. It just means you have to be reasonable. And if something's tiny and it doesn't matter, then don't get too much in an uproar over it. And our last one's conservatism. In accounting, I think you could say that we're kind of pessimistic. Don't know how to spell that, pessimistic. It's hard to spell and think. And I'm kind of an optimistic person by design, but in accounting, we're a little bit pessimistic. We take the attitude anticipate no gains and provide for all losses. And when in doubt, understate net income. Don't overstate it. Understate current assets. Don't overstate them. You'll never get in trouble if you choose to be realistic and to show something in a less favorable fashion. Whereas if you make the opposite decision, you might. Your free to pick which inventory method meets the needs of your business. So we're not saying you have to pick conservatism, saying LIFO, because it makes net income less and current assets less. More we're saying that you're being conservative in an overall way and not overstating things, and being careful to pick policies that reflect what you want to do, and being consistent. So they go together. This is the vocabulary of generally accepted accounting principles we introduced in Chapter 6. And probably a good place to end this first part 1. I guess we should put this up here. Pincast for Chapter 6. Thanks for joining me. Let's tackle cost of goods sold.